We are live. It is
Yeah.
value after hours. It's a little bit after the usual starting time, 10:38
Ish.
on the West Coast, 1:38 on the East Coast. No idea what it is, Australian Eastern Standard Time. Sorry, guys.
Too far
Might
away.
be like
Sorry.
5:30 a.m., something like that, 4:30 a.m. What's happening, fellas? We've been off for a little while. Billy's been off for a while. How is
Indeed, I
everybody?
have.
I missed you boys.
I was ready to go last week, but then no one showed up to the room, and I was left crying.
Wow, wow.
Yes, the world's smallest violin.
I had an eventful couple of weeks. Finally got COVID last week. So
Yeah.
that was
Congrats.
fun.
Congrats,
Now you're
indeed.
bulletproof.
Dodged that for 2.5 years and then took a little bit on the chin. So got that. Now I'm superhuman.
How did it hit you?
A couple bad nights of sleep with like fever and sweating in my bed, that type of thing, headache, aches. But then after that, I was pretty much back to normal. But I did my CDC recommended 5 days of quarantine.
There you go.
And wifey took real good care of me. I was like a prisoner where food would show up at the door and I would eat it and I'd leave my tray, back at the door.
Living the dream.
Yeah, that's the real dream. In the kids' room, by the way, like I was, isolated on that side of the house. So that's fun.
Nice.
Townsville, Craig Esberg in Townsville says that it is 3:38 a.m. I don't know what you're doing at, mate. It's way too early.
Yeah,
And you're going to
dude.
bed.
Shout out to you for showing up.
Townsville. Cool. I think there's lots of
3:38. This
contingent
dude tunes
Townsville.
in. Ask him, hey, Craig, are you drunk or did you wake up for this?
Shift work.
Oh boy.
That's dope. Good for him, man. I hope we make your
We can
morning
deliver.
somewhat enjoyable.
Cornwall, Rayleigh, Dublin, Nova Scotia, Estonia. What's up? Caribbean,
Oh.
Altamonte Springs, Florida. You got another flow rider down there.
I always find it odd how there's that many places with only 10 listeners, but
It used to be 12.
I
though. Remember when
digress.
it was 12? That was
Yeah, but-
funny when it was 12. And then, JT had his 12, 12, 12. I think it was the ghosts of 12 past. So that
Yeah.
happened.
and I ticked somebody off. They left me a nasty review on my podcast, so I guess we lost them as a listener. So we're down to 11, and then one died. So we're back to 10.
Santa Monica, Sweden. Wow, that's a good spread. Fellas, what have you got up on deck? JT.
Back with due to popular request, we've got another how the world really works segment to get into.
I think
that's
sperm
been-
whales is the most popular request that I've seen.
I
I've
was
been
hoping
shocked
it.
at how much people are liking the Vlatko Smeal episodes. So sorry, you're stuck with a little bit more.
Oh, that's great. Yeah, I've got David Einhorn's Q2 letter came out. Einhorn had some nice things to say about value, and a couple of little stats from Asness and Alpha Architect on the value spread, because I know that everybody likes the update.
Yeah. And what inning
Uh,
are we in, Bill? That's the other update we need.
I don't know.
Bill's been
This
trying
is
to
a-
retire it, I think.
This is
Yeah.
this is a tough. Yeah, this is a tough. It's a tough.
game.
Yeah,
Game to
I
call.
don't. The downside is tougher. I'm hoping we power bottomed already.
We lost Vin Scully, so we do need a baseball analogy this show.
Yeah, I don't know. This one's been. I've been kerfuffled through this one, so I'm not sure why I would know now. But jobs
Doesn't
are
matter.
strong. People are spending everywhere. Guy from Caesars says words can't describe how good his business is right now in Vegas. So, some recession.
What do you think that means? People are, you got two competing things, right? People are out. Are people still out and about from COVID lockdown? Is that still a thing?
I don't know. I mean,
Travel?
we were. I think generally we're all doing things in waves, and I think this summer is the wave of getting out. I mean, people have already booked things, right? But I don't know, man. I spent 3 weeks on the road. I saw people everywhere. Everywhere was packed, and I mean that's an actual quote from the CEO of Caesars. Words cannot describe how good our business is right now. So it's funny because all the experts were like, in 2021, well, when you read about what the comps were set up like, they were like, well, everybody was spending stimulus checks and, that's not going to repeat. And the guy's like, look, I'm telling you right now, September is comping to September of 2021 from a booking standpoint. I did like how he said that August is seasonally weak as Vegas is slightly less hot than the sun.
It is hotter than hell there in August.
Yeah, I thought that was pretty funny.
It's not like you're going outside.
Yeah.
Like, let's be honest. That's the best thing that could possibly happen. You're just stuck inside an air-conditioned casino.
I think he said 90% occupancy regardless. But yeah, it's interesting. Regionally cited as weak. I think that there's if you think advertising is a leading indicator, some of the ad companies seem to be taking it on the chin right now. But all of the coincident and lagging indicators certainly strong. So I don't know. We shall all find out together.
The 10-3, I've been watching the yield curve. It's a very strange shape at the moment because the 10-year is lower than the 2-year, but it's higher than the 3-month. Like it's right. It could be through it today. Who knows? It might bounce up. I don't know. But the 20-year and the 30-year are like, it's a weird kink in the. Well, when it's in contango, do you use that term when it comes to these kind of curves?
I think is the term.
Well, it's normal backwardation. It's not at the moment. It's in contango because it's the 10-year, the 3-month and the 2-year are above the 10-year, but they're not above the 20-year and the 30-year.
I gotta buy 3 months. Jesus, I'm leaving money on the table in too much cash.
It's like 3% or something, isn't it?
2.5.
2.5.
I mean, that's you can actually get some yield on that.
So that's the old Cam Hartwell. That's Cam Harvey's indicator. That's been pretty. The 10-3's Cam Hartwell. That's really, really close. Like it just could go through any day. It's been bouncing around right on the line. And I'm sure lots of other people have been watching it too, just for a technical. It has presaged a lot of other recessions and depressions. But, who knows? Maybe there's something else going on.
Yeah, I was kind of thinking about this the other day. And, there's been a lot of arguments about, are we in a recession or what's the, 2 quarters in a row of negative GDP? Okay, like that's fine. And, we sort of get hung up on semantics as humans, but like, nobody's saying it's coming in at 4% or, some big number that's going to help. Like we're arguing whether it's, is it plus a half or a minus a half or something. Like at this point, let's just say it's 0 and move forward with that.
But isn't it the comp? Isn't the issue that the comp is like the comp is blown out? So that the next 2 quarters there's been a big recovery and then there's 2 quarters that are lower than the big recovery. I thought that was the point rather than the exact number.
Yeah, all I'm saying is it kind of feels like much ado about nothing to me.
I appreciate your input. That's a very smart take.
You get to smack the sitting president. That's the only point.
Okay.
That's the only point of it.
It's a red no brew problem.
So it's one of those. It's a headline that you get to write in the paper, and then I think that's the only point. Like I think it's
recession.
Yeah.
Worst economy ever. It's never been this bad before.
Well, that's it. Everybody in relation to everything, like there's always this representative anchoring, all of these biases that whatever's happening right now is the worst thing or the best thing that's ever happened. Could be true for their life. Who knows? Unlikely.
Yep.
Yeah.
Very unlikely.
I thought Upstart's call was kind of interesting. And I think I think that people are getting to see that business finally. So they
what do they do there?
Well, they are an AI-enabled lending facilitation platform.
I'm sorry, you're breaking up.
Yep, that's right. But what's interesting is their constraint, unless they are not seeing the data correctly or they're frauds. I don't think the fraud thing. If anybody wants to allege that, there's on them to prove it, right? They claim their credit models are performing as good or better as they ever have, but the constraint is banks don't want the paper. And I think that what people may not appreciate is when you don't hold the underwriting on your own balance sheet, you're beholden to people to want to buy the paper. And if you've ever worked in a bank going into a recession or the fear of a recession, credit departments get very skittish. And it seems to me a good way to lose your job is to continue to buy, quasi subprime or arguably not rated paper right before a recession. Then the recession hits, then the paper doesn't perform well. And how are you so dumb to be the credit department that allowed the bank to buy that? Kind of an interesting development where, just a year and a half ago, one of my favorite Twitter personalities, Jonah the Juice, love that none of that they didn't hold their own paper, right? It's this asset light. Everyone can go everywhere. They can sell it to anybody, right? Anyone's going to buy the paper. And turns out you're as cyclical as your counterparty is willing to buy your loans.
Yeah, that's interesting.
Yeah, it has been an interesting development. Look at slide 4 of their presentation. They're either lying or their models are performing well, but there's not the appetite to buy the loans. And it's an interesting development. Now they're talking about maybe bringing some of it in-house. So we'll see how tech investors feel with financial multiples. I'll tell you this, It's not great.
Tim made the same point last week or the week before about not buying paper. Was that auto loan paper? What was the paper that banks weren't buying? Do you remember, JT?
Yeah, I think he was talking about subprime auto paper.
Ooh, I'd take that all day long. That's a good lend. People don't default on their cars, man.
I thought repos were like taking off right now.
I mean, they might be, but like the lesson from the Great Recession, if that now Wall Street can always take lessons too far, so who knows? But if the thing is, people would give in their keys to their house before they'd turn over the keys to the car, because if you lose your car, you can't get to work, right? Like you actually are permanently impaired. I guess maybe Uber changes that dynamic a little, but I think people keep their car at all costs.
That's why you get a motorhome, got both your bases covered.
Boom. Boom. Get long camping world.
I think there are a few around.
I like that.
I think there are a few around in the secondhand market there.
Yeah, I think so.
I think everybody got away and now they've come back and they want to get rid of them.
Everyone's like, RVs, that's awesome. Wait, never mind. I want to go to Hawaii.
Yeah, scuttlebutt on that I heard like a month and a half ago is when the brakes got slammed on some of the RV, a supplier to an RV, like floors. They do floors. Not so hot as of 6 weeks ago.
On the drive I was in Yosemite last week. In the drive to Yosemite, I noticed there are a few lots that were absolutely jam-packed with RVs. I don't know if that's usual, but it seemed like they had a lot of inventory on the lot. I wasn't in the market though.
Yeah, I was driving by Camping World seeing them, and there did appear to be a pretty full lot for Camping World.
Well, gas prices, certainly don't help that equation either. If you're trying to motor around the U.S. and it's costing you $1.50 a mile in gas.
Also, nobody fake news me and tell Cohotus that I'm out here talking shit on Camping World. I'm not trying to get on his radar. I got love for Mark. Jeez, something I don't need in my life. Camping World's bounced, bottomed in June like everything. Turns out everything's just one big rates play.
It is funny, isn't it? Everything just trades the same way. We've
just gone. Meme stocks are back, I guess, this week is or recently. Is that true?
AMC, GME. Yeah.
Did they?
Big runs.
Yeah, apparently it's all back.
I saw GME to $100 a share, and then somebody else said, no, $1 million a share. So
why stop there?
Something else ripped on like the fact that it was on a Reddit board, like all that stuff's going on again. Well, guess we got to learn these lessons a few times before they stick.
There's always a few bounces before the bottom.
I used to think I was too good to accept a meme, but if Reddit wants to meme some names, give me a holler. I'll give them some. I'll take it any way I can get it at this point.
Yeah, anything to get these dogs moving, huh?
Let me do some choice lines from Einhorn's letter.
Yeah.
I tweeted this one out yesterday, but I kind of like this. I like this one. The market is still dominated by the types of investors. It is germane to what we were just talking about, who we described in our year-end 2020 letter, those that either will not, index funds, cannot, untrained novice investors, or choose to not, valuation different professional investors, have valuation as a cornerstone of their investment process. A lot of these investors have had a tough go of it during the current bear market. That's a little bit gratuitous, but I just thought I'd throw that in there anyway. This is the more interesting line. We believe that part of the reason value stocks have fared better lately is that value investors have suffered a full redemption cycle, and there's hardly anyone left to sell. What do you think about that? Is that true? Is that fair?
Yeah,
I don't know
think
how
there's
you
something
time the
to that.
bottom.
No, you can't. But I mean, if you were a value conscious, I don't know what names we want to include in this bucket, but let's say whatever it is, and you think it's worth, you think it's a 50-cent dollar, which is the reason you'd be holding it, right? So you're probably not going to get rid of it until you get closer to that. Yeah,
closer to value.
or redeem, whichever comes first. But yeah, eventually that you run out of redeemers, and you run out of those who lost the faith, and that's I think how you bottom, right? Well, you just run out of sellers.
Well, I think Pzena, which is what I was just talking to you guys before we came on, but Pzena is a stock that I have held. That's Rich Pzena's investment firm. It's a systematic value fund. They've got about $50 billion in assets. I thought they were cheap at the start of the year, and they traded down 30% with everything else in this sort of sell-off. And now they've got to take private, basically where they were trading at the start of the year. And I think that's it sucks if you hold it, because I don't think it's anywhere near full value where it's going, but I can't blame them. They've been beaten up for so long. That's why they're trading where they are. But that's one of the concerns that I have, that you get this, and I think we're starting to see it a little bit. There's if you're a valuation buyer, private equity buyer, this is a pretty good market to be hunting around in. I'm surprised that there haven't been more announcements so far.
Yeah, one of the growthier ideas that I kind of like is T. Rowe Price as a stock.
Because they buy growthier stocks, or because?
Yeah, you got an asset manager trading at like a 12 PE, and they've got a long history of being like disciplined growth investors. It's kind of a derivative way to play growth through a value lens.
Yeah, I like that. Might be a good diversifier if you're kind of a real value oriented guy.
Yeah, and you want some growth exposure, but you don't want to pay asinine prices.
Or just buy the 3x ARC.
Could do that.
Which way? 3x short or 3x long? Both cover yourself.
Yeah, that's right.
Hedged. You gotta. You could make the argument that that's probably, it's either going one direction or the other. It can't stay here. This is the wrong price wherever it is today.
So ARC is a triple, or ARC is up or down, but wrong here.
It's wrong here, but yeah.
That's interesting. I don't know
either. I'm just making
Diamond Hill looks. I was just checking that out because that's another one. They look like they've probably outperformed the market over the past year, but they're P of 10. I don't know. I guess it's where these things trade. I have no idea. I don't know what I'm talking about. Disregard the words coming out of my mouth. I'm not sure that I buy that value's ripping because people are getting redeemed, but Einhorn's much smarter than I am. Is he the one that's on Twitter?
I think he said that it's relatively outperforming because the value has already had its full redemption cycle and there's nobody left to sell, I think was the point that he was making. Yeah, although that doesn't seem to be true in the stuff that I hold. There are plenty of sellers left. It turns out that every share is held by somebody who can sell it at any time.
Who are all these paper hands?
Yeah. We got to get some diamond hands in the value community. But why would you hold anything? Like, it just goes down. It's just brutal.
A lot of ways to lose money.
How do you think about rebalancing, Toby?
I think it's very important. I do it all the time.
I'm pro.
I know, but like, you know, like in your studies and stuff, like how did you think about when to rebalance, right? Because if you're betting on like the value factor, how I would think that like it depends, right? Does a stock outperform from 1 to 3 years after it falls in like the lowest decile? Can you rotate every quarter? Like, how did you think about rebalancing those buckets when you did those studies?
On average, and there's a study out there that says this, it takes 5 years for the excess performance to disappear, but the bulk of the excess performance is in the first year. Problem that you have is that, as you point out before, I don't know if you said that before we came on, but you know, it's nice owning something, but there's always something else to own out there too. And you can be in something that's run up a little bit, de-risk it by taking the position down, allocate to something else. I think that transition is what value is. That buying and selling is what the value factor is. Buy them when they're too cheap, sell them when they get more expensive, or rebalance the position down and rebuy something else cheap. That's been a pretty good strategy for a long time. It's been less good since about 2010, mid 2010, but it might have bottomed September 2020. I don't know. We'll see.
Is that a good segue for the AQR value spread?
Yeah, this is just a very simple chart from Asness. He says that it's at the 98th percentile, again, global value. It has been a little bit wider recently, but it's still, it's sort of blown out again. And then Alpha Architect's website has the EV/EBIT metric that compares the cheapest decile of stocks, the median in the cheapest decile to the median in the total universe. So as Jake pointed out yesterday, we're comparing the 75th stock to the 750th stock, which seems a little bit arbitrary, but there are good reasons for doing it. Basically, that spread was wider at June 30. It was 4.15, and it's come into 4.07 as at July 31, the last month end that we've had. But that's still, it's wider than it was in 2000. It's wider than it was in 2009. Both of those two events followed with very good returns for value. So that's kind of what I think. It's very, very painful to get there because the blowout means that you're underperforming. But at some point that starts closing. And if it closes as violently as it opened, then that should mean pretty good returns for value.
So
it's been a long time waiting for it.
Context to that. So what Wes is doing with that is you take 1,500 stocks, right? And then you like put them into order of basically, you know, cheapest to most expensive
on EV/EBIT.
On an EV to EBIT basis, and then look at basically the 75th stock, the 75th cheapest, which is the median of the cheapest decile, and then look at the 750th stock, which is basically just like smack in the middle of the spectrum, and compare those two. And what it's saying is that you are getting roughly $4 more of EBIT per unit of enterprise value with the cheapest compared to the median one.
I think that's fair. Yeah.
Trying to make it into like plain, you know, understandable.
4 times as much operating earnings as you are at the median.
Right. And that number historically has been around where, Toby? It's not been 4. It's been much lower than that.
I don't know what the average is, but the two peaks, 2000 was like a 3 handle. 2009 was like something like a 3 handle. So for it to be 4 is very, very wide. Much, much wider. You can look at that chart. It's astronomical. It's in my Twitter. It's in my Twitter feed.
Yeah.
It's wide.
It'd be interesting to see how some of these cuts that are coming, like, you know, a lot of these growth companies were overspending, and now the cuts are. I'll be interested to see how the next 12 months plays. You would think that they should show some operating margin expansion over the next 12 months. We'll see if that brings in the multiple a little bit, or the differential.
So you think margins are going to get bigger from where they are right now for S&P 500?
I mean, you would hope so. Otherwise there's a problem with a lot of these growth companies. I was thinking about this before.
12-13%. That's like,
yeah, I was actually doing dishes thinking of you the other night. Not in a kinky way.
Damn it.
I'm sorry. But one of the things that I was thinking about is, like, you know, Domino's Pizza is one example where, like, I think in the past, and I might be wrong on this because I have thoughts. I don't have empirical data. The best way to live, very ignorant. I think like Domino's might have been a public company in the past, like with the whole system. Like if we're rewinding in the 50s, right? Like maybe that's what they want to be. And now the franchisor is the public entity and all the shitty margins are in the private markets, like pushed down to like entrepreneurs or whatever. And I just kind of wonder how much of it's just a compositional issue. And then as these like capital light businesses have been rewarded with high multiples, how much that's like distorting relative to history, the margin profile on a market cap weighted basis.
Yeah. You say what you're saying is that like a lighter capital, better returns on capital businesses are the ones that end up being public as opposed to, you know, owning a bunch of pizza, actual like brick and mortar of the pizza place.
Well, certainly I think they're the ones that are rewarded with like these big multiples. And I think financial engineering has really run its course over the past 40 years or so.
Yeah.
Coincidental with interest rates getting squashed all the way to zero.
Yeah.
Yeah. Funny how those two go together.
And outsourcing, right? I mean, there's been a lot of things, but I think we shipped a lot of low margins overseas. I think the pandemic has shown how much fragility that can add. And I'm sympathetic to the idea that commodities, certainly after this Inflation Reduction Act, can probably catch a nice run here. And, you know, we'll see how that all works out. Oh, boy.
Do you want to do your subject?
I'm sorry. Well,
JT?
yeah,
Sure.
I think I understand how they're getting there. I don't know enough about pharma, but I think Medicare, I think I agree with Medicare, you know, negotiating with drug prices. I do think it's very funny how they're spending their way off of an oil dependency and calling that inflation reduction. I think that's rich. That's politics.
Yeah. They're good at framing these things.
Do you see Ford they raised the price of the F-150 like $8,500, and I'm pretty sure that's exactly
what they're getting.
The credit.
Yeah.
Oh, geez.
Cynical.
All right, veggie time.
Now do education. Oh. All right. So this is part 3 in our understanding of the world, and this is how the world really works.
Has he had a go at financial markets? Because I'd be interested to hear how they actually work too.
Yeah, that would be nice, wouldn't it? This segment is on understanding our material world. The first one was on energy. The second one was on food production. And this one is on 4 basic key materials that build our world. And those are cement, steel, plastics, and ammonia. Now you might be wondering like, hey, what about silicone? That's like, or silicon, I should say. Isn't that what the modern world is built on? Well, Smil says that like billions of people could live prosperously without silicon. And it's not an existential constraint on modern civilization like these other 4 key ingredients. So just to hit you with some metrics on these, the 2019 world consumption, 4.5 billion tons of cement, 1.8 billion tons of steel, 370 million tons of plastic, 150 million tons of ammonia. And by the way, the mass production, just to tie this back into our previous segments, the mass production of all of these depends heavily on the combustion of fossil fuels. About 17% of the world's primary energy supply goes into creating these 4 key ingredients, and about 25% of all CO2 emissions. So the modern world, again, as we've been saying kind of over and over again, is running on fossil fuels. So Smil says that ammonia is actually the most important of all 4 of these, which is a little surprising. And a lot of it is because without it, it would be impossible to feed at least 40 to 50% of the world's 8-ish billion people. So 60% of China's agriculture is available only due to synthetic ammonia. And so feeding basically 3 out of 5 people in China would not be possible without the production of synthetic ammonia. The global average is around 50%. And this huge dependence actually sort of justifies the claim that the Haber-Bosch process, which we talked about a little bit before, which was this heating up of key ingredients that then create ammonia. Spiel says that it's perhaps the most momentous technical advance in history because it allowed our population to get so much bigger. So let's jump to plastics then. The synthesis of plastics is basically like you take these small molecules and they can be bonded together into longer and longer chains and branches, and they make what are called polymers. So you take these monomers and turn them into polymers. And there are two key monomers, which are ethylene and propylene. And they're basically produced by heating hydrocarbon feedstocks to like 750 to 950 degrees Celsius. So again, huge carbon, input to get any kind of heat like that. But their ability to mold these plastics is what makes them so valuable, because we can put them into all kinds of shapes and sizes, from thin film to heavy duty pipes, super light, bottles that you drink out of, to massive sturdy waste containers. Like it's hugely valuable for us to be able to create the form factors that we need with the thickness and the properties that allow. So polyethylene accounts for about 20% of the global production of plastics. Polypropylene is about 15%, and then polyvinyl chloride, which is PVC pipe, like you guys have heard that before probably, that's about 10%. Global production of plastics, 20,000 tons in 1925, 2 million tons in 1950, 150 million tons in 2000, and 370 million tons in 2019. So, you can see this sort of exponential curve that's pretty wild. All right, steel. Steel beams can bear loads that are 15 to 30 times higher than granite columns. So like a steel's tensile strength is about 7 times that of aluminum, and its hardness is about 4 times. So, and it also has a much higher melting point, which is about 1400 degrees Celsius for steel, as opposed to about 660 for aluminum.
Does jet fuel burn that hot?
All right, there, truther. Let's just keep moving here. So basically, tall buildings, bridges, radio and TV towers, electricity transmission, the big towers that we send the electricity through, oil and gas production platforms, railroad tracks, ship hulls, shipping containers, tools, machinery, boilers, nuclear reactors, oil refineries those are essentially just a forest of steel. And, of course, all the weapons, tanks and guns and stuff. So, a huge part of our world is made up of steel. And it's also actually the largest part by weight of transportation equipment. So the average car contains about 900 kilograms of steel, which is about 2,000 pounds. So are we going to run out of steel? Very unlikely. Iron, which is a huge component of steel, is the 4th most abundant element in the Earth's crust, behind oxygen, silicon, and aluminum. And the annual production of iron ore is about 250 billion tons. The world's resources are in excess of 800 billion tons, containing about 250 billion tons of ore. So if you look, any kind of resource, when you look at it, you can do like a resource divided by production calculation to see like how much of it do we have versus how much do we produce every year. And that's more than 300 years worth for steel, as opposed to oil. Actually, its RP is like 50 years currently. So we're in good shape. Interestingly enough, recycled steel actually accounts for about 30% of the total output, 70% in the US, 40% in the EU, and only 12% in China. So that could be a place where we might actually save a lot of steel production, would be if China did a little bit more recycling. A lot of that probably has to do with the fact the age of it. We're turning over steel from the 20th century. Total energy requirements of global steel production in 2019 was about 6% of all the energy that we harnessed. All right, next up, concrete. Cement is this indispensable component of concrete. It's produced by heating basically ground limestone to at least 1400 degrees, along with some other materials in these large kilns. And so concrete consists of about 65 to 85% of aggregates, which are, sands, rocks, things like that. 15 to 20% water, and then the cement is about 15 to 20% of the final mass as well. So, it's been the most massively deployed material to create modern civilization. It's hard, it's heavy, it's ready to withstand decades of punishment, and especially when it's reinforced with steel, because it helps to combat the fact that concrete is actually pretty weak when against tension. So like if you twist concrete, it cracks, but if you try to compress it, it doesn't really, it withstands that well. So to give you an idea, like the Pantheon was completed in 126, CE. That's like 2,000 years ago, and it still spans a distance greater than any other structure that's been made of non-reinforced concrete. Pretty impressive stuff. So today's best concretes can withstand pressures of up to 100 megapascals. To give you an idea of how much that is, that's the equivalent of the weight of an African bull elephant balanced on a coin, like sideways. So picture an elephant, pushing down on a coin, very small surface area, a lot of weight, pretty impressive. The most massive concrete structures that we have are dams. To give you a sense, like the Hoover Dam required 3.4 million cubic meters of concrete and 20,000 tons of reinforcing steel. I didn't realize this, but the Three Gorges Dam in China is 28 million cubic meters of concrete and 256,000 tons of steel. So it's almost like 10x the Hoover Dam, which is pretty damn impressive. See what I did there? Annual cement in America, the consumption rose 10x from 1900 to 1928, up to 30 million tons. It tripled again by the year 2000. The peak was actually in 2005 at 128 million, and now it's back down to about 100 million. Now in China in 1980, less than 80 million tons per year. By 1985, they'd passed the US. In 2019, the output was 2.2 billion tons. So just over half of the global total. And this is an insane thing. If you take 2018 and 2019 and add them together for China's production of concrete, it was the entire US 20th century total of about 4.4 billion tons. So in 2 years, they did what we did in 100 years. And of course, all of these rely heavily on fossil fuels, as we kind of keep beating this drum. And it's especially concerning if you're living in a place that today has like low income and is relatively unmodernized, in that you have huge infrastructure needs, right? Like that's how you're going to get onto the sort of modern economy with, having lots of infrastructure. And basically infrastructure comes from these 4 key materials. So unclear how we're going to be transitioning all this stuff. You guys might have seen some of these before. Like I think it made the rounds on like what actually goes into an electric vehicle. And it's frankly, it's kind of daunting. Like the typical lithium car battery weighs 450 kilograms. And in that is 11 kilograms of lithium, 14 grams of cobalt, 27 kilograms of nickel, 40 kilograms of copper, 50 kilograms of graphite, and 181 kilograms of steel, aluminum, and plastic. Well, supplying all of these materials for a single car requires processing about 40 tons of ore. And given how low the concentration is of a lot of these elements, you actually have to extract and process about 225 tons of raw materials per car. So think about, just the amount of energy required to process and extract all of these things to create per car 225 tons of raw material. Jesus, this is quite a Herculean task. So the idea of switching everyone over to electric cars very easily, with the current battery technology, it seems like a pretty daunting task. So anyway, that's what your modern world is built out of. And hopefully now you guys can impress your friends at cocktail parties with some random ass facts. So.
How much of that stuff do we have left? Is there any, what are the constraints there?
I think we have most of everything pretty readily available. I think it's just a matter of like, how expensive is it to get it out? That's the question of every natural resource that you want to capture. Is there's always more, but at what price point, right? Like you have to dig deeper for it. You have to process, lower quality ore to get the same amount of, what the material that you're trying to get out of there. Therefore, you have to, move more of it through. So I think it's always a question. Quantity demanded is always a question of, how much does it cost to get it? Or we just figure out how to mine asteroids, and then it's all good.
That does sound a bit easier. What's the name of the book, JT, for folks playing at home?
How the World Works by Vaclav Smil.
Hydrogen is the key transition fuel for industry. Not sure what that means. Can you elaborate a little bit? Yeah, I don't know where to go with that, JT. That's so China making 2019, 2020, was it? They made more than the
18,
US
18
made.
18 and 19. 2020,
Yeah.
we had a thing going on that slowed all
we didn't
that.
do a lot. 18 and 19, they made more than the US made in the 20th century.
Yeah. I mean, huge, highway systems, apartments, dams. I mean, they just been building and building.
Are they all occupied? So like those ghost cities? Is that real?
Yeah, I think those are real. The ghost cities.
Yeah.
I don't know. It's an interesting question. Like one I struggle with, like one way I sort of try to think about some of these bigger capital allocation questions, because that's what it is at the end of the day. Like, what is getting built and is it providing the goods and services that people actually demand? And the further away the decision is made from the actual customer, I think the greater the chance of an entrepreneurial error being made and a misallocation of capital happening. So if we, let's say you're China and you are building all of this stuff, the idea is that it's going to be providing all these goods and services for your people. And, I think infrastructure has a probably better chance of being on point with what society is demanding, but at what quantity, I don't know, and like how quickly. And I think, boy, to put that much money or to direct that much resource over that short a period of time, I think really increases your chances of having a misallocation of capital, as opposed to like going a little bit more incrementally and seeing like, okay, well, what's the uptake? Like, why build that 150th ghost city? Like, we should have stopped at like 149. But maybe the people just keep coming and off of the, from farms and filling these up, and eventually it works out okay, but before they deteriorate. I don't know. But I do think it is kind of a precarious position.
How much of a constraint are those rare earth materials on making batteries? I heard that they were like, that's Musk's talk about mining his own lithium, was it?
Yeah, I mean, I think there's a lot of different rare earth that goes into there in different quantities. Again, I think it's a cost thing, right? Like you have to have you could probably find them almost anywhere, but like at what concentration? And so you need a higher concentration to keep the cost down. And I think I think the US is in okay shape there from what I understand. I think, China also supposedly has a good mining capabilities for rare earth. But I'm not sure how that fits into the rest of the globe, like where else. I mean, to give a sense, like I know that Africa has been hardly explored at all when it comes to those kinds of things. Like the penetration of soil in Africa is like woefully under penetrated relative to other places on Earth, because it's just, there hasn't been anyone in there digging around looking for stuff. So who knows what like gems might be hiding in there eventually. Like maybe there's an entire fields of things we don't even know about because no one's really looked. But
this is from JP Morgan. Outside of lithium, mine supply of critical elements is highly leveraged to China. With over 60% market share, the Democratic Republic of Congo dominates cobalt production, yada, yada, yada. Chinese companies now own 15 of the 17 cobalt operations in the DRC and control 97% of Indonesian supply. The skimming down the page, it's not just mining. Lack of smelting and refining capacity also holds the U.S. back on minerals. Today, China controls 85% of rare earth refining.
So while we were like, canceling each other and doing whatever the hell here, they were off like securing all these
buying up the world.
Yeah, that's good to hear.
Yep. Controlling the midstream of the supply chain has helped the country become the world's leading producer of electronic cars. I don't know. It's going to be interesting. They've got a chart here. China has, it looks like, greater than 70% of the world's graphite. It looks like 40-ish% of nickel, almost up to 80% of cobalt, and it looks like 70-ish% of lithium.
How hard is ammonia to produce?
I don't know.
It's not, I don't think it's incredibly hard. I think it's, you have important feedstocks, like natural gas is an important part of it. Like that's where the hydrogen part of the ammonia comes from. So, but it takes energy to do it. Like you basically have to like crack or boil this stuff to, or, a really high level to get the ammonia out of it, or to concentrate it to create ammonia. So, I think we've got a pretty good handle on how to do that now. We've been doing it for 100 years, but again, it's a cost thing, right? Like how much are your feedstocks costing up? If you've seen the price of natural gas in Europe, like it's gotten pretty expensive, and that's probably why Dutch farmers are not too happy right now. Like their input costs going up a bunch. So, I mean, it's always at what cost, all of these things, right?
This is a bit of a segue, but did you guys see the what's the I just saw it on Twitter, but there's a tax on buybacks.
Yeah, 1%.
How does it work?
I think it goes in next year, and who's her name, Cinema or whatever, from Arizona, she wanted it. They didn't tax carried interest. They put the 1% tax on buybacks for companies that earn over $1 billion. I think it's of operating income, but maybe it's net income. So it's an additional tax on capital.
So carried interest got through and buybacks got taxed.
Yeah, which I do think when you look at the numbers is less offensive, but there's something very offensive about it that I find.
Yeah, I mean, that's like, that's a very plutocratic type of move there. Come on.
Yeah, I think, I mean,
does anyone have a good counter argument for the carried interest loophole?
No.
Anyone, like with a straight face, can make one?
Yeah, no.
The argument, I guess, is something like it becomes long-term capital gains.
Yeah, but they kick in fees that are earned from effort that's based on, like, they get a deal and then they throw in a 1% acquisition fee. It's not like I mean, I get it, but it's compensation for work that is rolled into a deal and then taxed at favorable rates. And it's all like compensation for your normal course of business activities. That's the problem, right? Like,
but you should be paying at your marginal rate on your fee, on your management fee. It's the carry that gets the preferential treatment. I'm not trying too hard to defend it. I'd rather see that tax than buybacks, but that's the argument, I guess.
Yeah. I don't know what look, net, a 1% tax on buybacks and the Republicans' tax package a couple of years ago, you're still ahead of where you were. But,
yeah,
and they're only taxing, in theory, mature corporations.
I live in California.
I just don't understand this whole taxing buyback thing. It's like delusional to me. But if people want to hammer Walmart and mature companies for buybacks, like, I guess go ahead. People are going to end up spending 1% more in the store.
Can you do that?
What?
Do they have pricing power like that?
I mean, I think a lot of companies do. I think a lot of, like Bed Bath and Beyond didn't, right? They're going to tax Bed Bath and Beyond. But I think it's funny because, like, the narrative is like, oh, well, they're buying back all these shares to juice their stock price. I'd like to see an empirical study that actually shows whether or not buybacks impact share prices. I think for every AutoZone, there's a lot of companies that have gone out and they bought back shares the whole way down.
Yeah, the research is that they do most of the buybacks at the top of the market, and there are no buybacks at the bottom of the market. It's rare companies that actually do the buybacks at the right time.
Yeah.
I'm a boomer, so I actually like dividends anyway.
It got more expensive to hide your stock-based compensation, sins.
Yeah.
Send tweet.
But it didn't even, because the serial diluters are not the ones that are going to get paid, because they're not going to get taxed on some of the dilution because they don't generate income.
Smart.
Next level.
It really is. That really
no
is.
profits, no tax.
That's right. Yeah. So it's weird.
I mean, the other thing too about that is like 1%. Like, what are we even doing here? Like, it's just theatrics.
Administrative. That's the cost of that's the brokerage on the acquisition.
Yeah.
Whereas, yeah, you just add that on top of the brokerage. Doesn't make any difference at all. Would that change my strategy of going after companies with big buybacks? No. 1% is not enough to move the needle one way or the other. As I say, it's just brokerage.
Yeah. I mean, I'm not selling anything that's buying in shares right now because of the 1%, you know. It's an annoyance, but whatever.
Buybacks didn't turn out well for Intel or Boeing. Yeah.
Yeah. Or Bed Bath and Beyond, or like a ton of companies. Like, I mean,
IBM.
Yeah.
Why did Buffett get that one wrong?
Oh, probably because he didn't know what he was doing.
I'll let you tell him that.
Well, I think he was wrong. That's fine. That's what happens. It's a game. If you're good at the game, you're wrong 40% of the time. 40% came out.
All right. Here's a question from the crowd from Lorenz Muller. What sectors are truly hated in your view, except cannabis? Energy, oil and gas.
I don't know, man. Oil and gas got so loved for a while. It was impossible to do anything without hearing about oil and gas. I'm glad that period is over.
It's still smaller than it has been traditionally as a proportion of the stock market, total capitalization.
Yeah.
I don't know that it's going to revert, but
boy,
anything cyclical. I mean,
some big quarters.
Yeah.
Buffett is betting hard that it is. Like I've seen he's bought Chevron and he's still buying Oxy.
He's going to own the whole thing. Oxy is a special situation. It just isn't yet, but it is.
Why do you think it's a special situation?
Because he's going to take it out.
But why does he want it?
Because there's tons of cash flow.
Yeah. I mean, I think Charlie has been pretty adamant about wanting to own, like thinking that if you can control production and the capital allocation of an oil company, and you can restrict how much you're going to drill over the long term, that's going to work out okay. The rumor that I heard is that they view this as like a real 10-year plus investment. So if that's the case, I could see wanting to have fewer people control how much they're drilling. And by fewer, I mean Berkshire.
That's time, amigos. We made it.
No, we started late? That's a shame. People are going to clamor for more.
Leave them wanting more for next week.
Well, yeah,
all right.
Barely.
Well, enjoy the bear market.
Finally got the soundboard.
Yes.
All right, fellas. We'll see you next week.
All right. Good show, gents.
There we go.